Hey everyone, welcome back to POA for you. It's Leroy again, and today we are going to go through paper 2, question 4 of the O-level specimen paper 2021. This is at the request of Zachary, who has asked us to go through some scenario-based questions, and this is one of the questions he's pointed us to. Zachary, hope this is helpful for you, and for the rest of you, hope you enjoy this. And if you know of a friend who could benefit from this video, please feel free to share it with them. Free resource for everyone. Let's get right into it. Okay, so some information about this business that Lim runs. Sales on credit, that means he doesn't get cash on sale right away. He gives customers some credit to pay later, and that's usually 30 days later. There's no discount if they pay earlier, but they usually would pay 34 days on average. Now he's saying that there's a new customer who's come to him and say that, hey, I want to buy from you, and I will bring your products or the products that I make from your products overseas. And then Jennifer is saying that she has run a business that is very successful and expects her business to double within a year. So which means that whatever she buys from Lynn would double within a year as well, because if her business doubles and she's buying from Lynn, then especially if she's buying from them exclusively to make her products, then that would have a ripple effect on Lim's business. Jennifer's business, she usually pays her suppliers within 35 days, and she can also provide 2 current suppliers that she buys from as referrals if Lim needs that, right? So the question is, should Lim sell to Jennifer or not? So this is what I've said. I think he should sell to Jennifer. Now, why? I think that's the key important. In a nutshell, I think this will improve Lim's sales revenues. If you remember how the statement of financial performance looks like, it always has a sales revenue and then a profit. Now, in this simple sales statement of financial performance, sales revenues is 10,000 this year, and if I have more customers, that means the sales revenues will go up, and maybe one day it will hit 20,000. And look at what this would do to profits. It will increase profits as well, assuming all costs are constant. And of course, sometimes when sales revenues go up, some of the costs, especially indirect costs, would also go up. But it's more controllable. You'll get economies of scales and stuff like that. But anyway, you should think that if you get more business, your sales revenues will go up, and that will bring up your profit for the year as well. So if that's the case, then of course we should buy it. This Lim should sell it to Jennifer. But at the same time, you are not really compromising on the liquidity of your business. And what does that mean? Basically, let's look at some of the explanation that I have prepared for you that gives us a bit more color about what I mean by increasing sales and profits, and also without significant impact to liquidity. So the first point in terms of justification I've written is this: Jennifer operates a business overseas, and if Lim only sells to customers that operate a business, let's say in Singapore, then having a customer that operates a business overseas naturally expands your market, right? And also then your growth opportunity would be from our island of Singapore to, let's say, Malaysia, to Thailand, to Cambodia, etc., etc. And there are more people and more business opportunities for you to sell your products to. And given her sales forecast is very strong, then if we have reason to believe that that sales forecast is really solid, then there is a strong likelihood to believe that doing business with her would increase your sales revenues, and that's really beneficial for Lim. Now, payment terms for Jennifer is 35 days, right? And that's not really very different from his other customers of 34 days. So by admitting Jennifer, you are extending the same degree of credit to customers, and it takes the same number of days for your sale to convert into cash, 35 days. Now, just imagine in the worst case scenario, Jennifer comes in and say that, hey, I got a very good business, but I need to take 200 days to pay. Then it will take longer for that amount that you sell to her to convert into cash, which means that your business may be drained of cash, and that's not a nice position to be in, especially if you have debts to pay or your business has debts to pay. Moving along, the third justification I have is, she's provided references and you can validate whether Jennifer is saying that she's a good customer that pays within 35 days or not, or is she a reliable person to work with. But also these references have a relationship with her, and sometimes you got to take that with a pinch of salt, which also makes it reasonable for you to actually request for Jennifer to provide her audited financial statements, whereby these audited financial statements have been reviewed by an independent party, and you can pick that report up and look at her statement of financial performance over the years and statement of financial position to see whether her business is actually doing well, and also that would also give an indication that if she is someone who has the ability to pay on time. So that's it for part A. Let's look at part B of the question. Part B tells us some additional information about Tan and Lim, and has asked us to prepare journal entry to write off the outstanding balances as of 30th September. So let's see what's happening here. So I've prepared a leisure account, and obviously we don't know how much needs to be written off, and we need to kind of work through what's the activities in the month of May to determine that factor, and let's do that right now. So in the 8th of May, we have goods that 800 that Tan sold to Lim, and supplied to Tan. Lim sold to Tan. So 8th of May, we have a double entry of debit trade receivables, credit sales revenues in the books of Lim for trade receivables on customer Tan. And then the next May 15th, Tan returned some of 200 of these goods that you sold to him, and so he's owed us less, and then he owes us now 600 because you would debit sales returns, credit trade receivables. And the next May 18th, Tan actually paid Lim, so you debit cash at bank and you credit trade receivables, and then the balance is 350. Now on May 25th, Tan paid the outstanding balance by check again, so you would debit cash at bank, the outstanding balance, and he would then by this time owe you nothing. But then on May 29th, the check bounced, or the check was returned because there was insufficient funds in Tan's account. So what do? You have to reverse the entry that you did in May 25th. So in this case, you would debit trade receivables and credit cash at bank and reinstate the amount that Tan still owes us, or Lim. So at the end of it, you have to prepare a journal entry to write off this balance. And when you write off this balance, you would put the journal entry as, think about it, see whether you could do it yourself. I'll show it to you right now. Debit impairment loss on trade receivables and credit trade receivables. So what would happen here is September 30th, you would then put here impairment loss on TR, and then you would put 350, and then this would be 0. And Tan's account will be striked out, and you will bring this impairment loss on trade receivables to the statement of financial performance as an expense. Okay, now the next part, explain why business may decide to make an allowance of impairment for trade receivables. So I've prepared some answers here, and basically, if they see the risk that the customers may not pay them for the outstanding balance, then they would start to make this allowance for impairment of trade receivables. So when the customer is facing financial difficulties, or whether there's a dispute with the customers on, let's say, the balance, or or some other telltale signs, like when the customer pays you and the customer's checks has bounced because of insufficient funds, and the customers disappeared because you can't contact the customers to follow up on this. So there is a risk on the amount that you can collect, the collectability of this amount, right? And the rationale for doing this, of course, is you don't want to overstate the trade receivables balance in the balance sheet or the statement of financial performance. Now, this 350, if everything was okay would have gone into the statement of financial performance, statement of financial position as trade receivables. But if it is at risk of not being collectible, then you're gonna write it off to the impairment loss, create an impairment loss account for it to bring it to the statement of financial performance as an expense, and leave the zero balance into the statement of financial position. Now, what's the accounting theory behind this? Part D, prudence. Now, what is prudence? Your textbooks should say it, but it's about being conservative and in such a way that you don't want to overstate the value of your assets. And in this case, trade receivables is an asset, and this 350, if it's not collectible and you present it in the statement of financial position, it is overstating it because it's not collectible. So if it's not collectible, bring it down to zero and you state it in a fair position where you're saying that you got no trade receivables. So that's it. Hopefully this is helpful for you guys. And Zachary, hopefully I've answered your question. If you have any questions, any one of you, feel free to reach out to me. You know where to reach me. It's you can reach out to me in my channel, or you can email me directly at poa4you@gmail.com. My email address is always on the top left hand corner of this sheets that I work with. Okay, take care for now, everybody. Bye bye.